I'd like to talk about performance evaluation. One of the main applications of financial theory is in the actual reward of managers or replacing of managers for performance or underperformance. Now, we've already developed the tools whereby we can go through and do a reasonable first cut at the performance evaluation problem. For example, one thing that we've looked at is something that's referred to as the Sharpe measure. Now, I didn't call it this before, but let me define the Sharpe measure as the expected excess return on a security or a portfolio divided by its volatility. Now, the Sharpe measure gives us a reward to risk ratio. However, let's be careful about what we refer to as risk. In the denominator of the Sharpe measure is the volatility of that particular asset or project. So in order for this to be risk, it must be the case that we're looking at projects that are mutually exclusive. That means you can either do one or the other, and we assume that you do not hold a diversified portfolio. So the Sharpe measure is only a valid measure of performance evaluation when we're talking about mutually exclusive situations. It's the expected excess return divided by the volatility. It's a simple measure to calculate, and you hear practitioners talking about Sharpe measures all the time. Of course, the major shortcoming with the Sharpe measure is that it looks at the volatility of the particular asset and refers to that as the risk. We could improve upon this particular measure by looking at a different type of performance evaluation measure, and that's what I want to do next. What we could do is to look at performance evaluation in the context of an asset pricing model. So the asset pricing model delivers a beta for the security or the portfolio, and there's a risk premium that's associated with the beta. We multiply the two together and we get the expected return on the project given the level of risk. Now, there's a realized return. We compare the realized return to the actual return, and we get a difference, which we can call the performance. If the realized return exceeds what was expected given the level of risk, then we say that this asset or this manager has performed better than expected given the level of risk. Sometimes we call this the alpha. And we always look for positive alpha. And sometimes people are kind of loose in talking about alpha, and they'll say, I'm an alpha manager. Well, I think it's better to be known as a positive alpha manager. You want to achieve a return over and above what's expected given the level of risk. So we're always looking for alpha. And the alpha concept was first introduced by Michael Jensen in his dissertation in 1969. And Jensen studied the performance of a number of mutual funds. And he measured their alphas. And in the lecture note, there's the original graph from Jensen's study. And he noticed that the performance of these mutual fund managers was less than distinguished. That most of the alphas were negative. A few were positive, but there was only one that was significantly positive in the statistical sense. Now, there's some other hybrid measures of performance. There's a measure that kind of looks like the Sharpe measure, and it's called the Treynor measure, named after Jack Treynor. And it is the expected excess return on the security divided by its beta. Now that actually makes a lot of sense, because remember we said that one of the problems with the Sharpe measure was that the denominator had a measure of risk that maybe wasn't the measure of risk we really wanted to consider, especially if we had a diversified portfolio. Well, this other measure divides by the beta, and that is the risk. That is the contribution of the security or the portfolio to the variance of a larger portfolio. So this measure makes a lot of sense. There's a lot of other measures that are detailed in the lecture notes, and I'll talk about one measure that has got some recent play, and actually I'm part of this measure, so it's a little embarrassing talking about it, but it's what's known as the, I guess now, is the Graham Harvey measure. So let me talk about that. We can think about the Sharpe measure. Let's go back to the Sharpe measure in the following context. Think of the efficient frontier. And think of the tangency portfolio. And let's call that the Standard & Poor's 500 portfolio. And then we can connect a line from the risk-free rate to that market portfolio. And that is the market Sharpe ratio. It's the best possible Sharpe ratio that you can obtain, given that it's a tangency portfolio. It's best in the sense that it's got the highest possible slope. And the highest possible slope means that you get the maximum expected return per unit of risk. And risk in this context is the variance of the well-diversified portfolio. All of the efficient frontier portfolios are well-diversified. And we're getting the maximum reward per unit of risk. And this is exactly the ratio that goes into the capital asset pricing model. This is the way that beta is rewarded, in that we are assuming that people hold well-diversified portfolios. So the Sharpe ratio for the market is very important. Now, that said, if we look at Sharpe ratios for individual securities, I already mentioned that that this could be a little problematic, because we're looking at the variance as the risk. And it's possible that a number of these portfolios have Sharpe ratios that are less than the market Sharpe ratio. So Graham and I come along with the following idea. What we do is we say, okay, here's a security or a portfolio, and actually our application is a bunch of managers that are making recommendations for portfolios, investment newsletters. So we look at the recommendations and look at the portfolio that obtains from that. And that portfolio's got an expected return. That portfolio has got a variance or a standard deviation. So this is what we do. We form a portfolio of the market, the Standard & Poor's 500 or the Morgan Stanley World Portfolio, whatever you want to define as the market. But we form a portfolio that has got exactly the same volatility as the strategy that the manager is recommending. And that portfolio has got an expected return. Our manager has got some return that's realized. And we take the difference between the two returns. And we call that the Graham Harvey measure 1. Now let me rewind just a little bit. We're looking at a strategy that has produced a standard deviation and an expected return. Let's say the standard deviation is 20% and the expected return, or the realized return, was 15% over this manager's tenure. What we do is we form a portfolio, and actually we use the futures market to do this with the S&P 500. we form another portfolio that has exactly 20% volatility. Exactly. And it is a combination of the S&P 500 futures and a money market deposit that has exactly 20% performance or volatility. Then we look at the realized return. And if the realized return is 20%, then the difference between this passive portfolio and the manager's portfolio is 5%. If we had done the passive strategy of just investing in the S&P 500 and a treasury bill, we would have earned 20%. If we'd followed this manager, then we would have earned 15%. Therefore, the Graham Harvey measure is minus 5%. So this Graham Harvey measure has a number of advantages over, let's say, the Sharpe measure. And one advantage is that if the measure is positive, it means that you have exceeded the ratio of the market Sharpe ratio. It means that you're on the right side of the efficient frontier. You're above the frontier if the Graham Harvey measure is positive. The Sharpe ratio alone, if you're looking at the Sharpe ratio of a number of securities, it doesn't give you that information. Indeed, you could have a Sharpe ratio that's the same for two securities, and one security is above the efficient frontier and the other security is below the efficient frontier. That's a serious problem with the Sharpe ratio. That problem can never arise with the Graham Harvey measure. If the measure is positive, it means that you have exceeded what could be obtained with a combination of an efficient portfolio and treasury bills with the identical volatility. So it is a measure that if it is positive, it means that you have beaten the best. And if it's negative, it means that that you could have done better with a passive strategy of the S&P 500 and treasury bills. And again, let me emphasize that this doesn't have to be the S&P 500. You can apply our measure to any national index or a world index or a regional index. It doesn't matter. It's independent of the actual index that you use. The last thing I want to talk about in performance evaluation is a more advanced topic. And I'll be brief and I'll let you take a look at the lecture notes on this. That the original Jensen study in 1969 was published a long time ago. And it's interesting, there really hasn't been that much academic research on mutual fund evaluation since that study. And the main reason is that the Jensen study was so definitive, and any other follow-up would just be considered a follow-up. I've embarked on a paper that updates the Jensen 1969 study and does some new stuff. And it's interesting that when you update the Jensen study, and we updated it in a very, how should I phrase it, unusual way. We looked at mutual funds that have existed from 1968 through 1994. And you know there's 4,000 mutual funds out there today. How many mutual funds have existed from 1968 to 1994? So we require them to be alive for that whole sample. Well, it turns out there's less than 80 funds that have gone on that long. So we decided to evaluate the performance of those funds that have been around a long time. Now you would think that given our sampling rule, that we should find tremendous returns. because we have constructed on purpose a sample of funds that are plagued by survivorship bias. That is only the funds that, by construction, that have done well, that have survived, that are in our sample. That we don't look at the funds that went from 1968 to 1973 and then disappear. Only the winners we look at. And it is remarkable that when you look at those survivors, the performance of these funds is mediocre at best. So no matter how you measure that performance, whether it's by the capital asset pricing model, by a multi-factor asset pricing model, and in my paper with Bonsall, we actually look at a version of the asset pricing model that allows for risk to shift through time. Even if you do that, the performance is mediocre. So the lesson here is that if you think that you're going to get a great deal by investing in the mutual fund, you're wrong. The performance can be achieved or exceeded by a passive portfolio that might be linked to the S&P 500 or whatever global index. The key thing in this part of the course is to think about a reasonable way to evaluate. We've gone through a number of different methods and explored the strengths and weaknesses of these methods. You know, a lot of the time you see such naive materials like 3 stars or 5 stars if the absolute return looks good, or a smiley face on Consumer Reports. That doesn't cut it. We have to go beyond that. You just can't compare realized returns. That doesn't make any sense given what we've done in this course. We have to compare apples with apples and oranges with oranges. We have to put these securities on the same risk level. If one security has a higher realized return than another, then for me it doesn't really mean anything. Like, I know that on average an equity is going to have a higher return than a treasury bill. And that's simply a result of the equity having higher risk. So we just can't compare two returns or two managers. We have to be smart about it. And financial theory gives us some of the tools whereby we can be smart and evaluate things on a risk-adjusted basis. Performance evaluation is a very important concept. It has very important economic implications for the economy because we want our assets managed in the most efficient possible way. So this is a very important application of asset pricing.